Hey, welcome everybody. We're excited to spend this time with you. I've got a fantastic speaker, and we're gonna introduce him here in a bit. But our goal here is to have a great conversation about best practices on strategies around tax and wealth building, and how to maximize your opportunities and how to protect your wealth just along your journey here. And one thing I'll say is we're recording this, so you all have access to this after the fact. Also, we have a chat window. If you have questions that you'd like to ask, type those in the chat window, and we'll be able to answer those along the way. So without further ado, we're going to jump into it here, so I can respect everybody's time and stay within the hour block that we had. Yeah, so corporate battlefield. Go ahead, next slide, Mike. We're having an annual event here in October. It'll be here in Austin live. We would love for anyone that's on this call to join, or anybody that's viewed it. You can use the QR code to find more information about it, or you can just go to skylarwilliamson.com and go into our events tab. We do webinars like these. We do in-person meetups for masterminds, and then we do this annual conference. And we've got some great speakers. And one thing that I want to point out that I'm proud of is 100% of the ticket sales and the sponsorship dollars, they're all going to teachers who are in financial need. So trying to just, we're not looking to change the world with this, but we are looking to help some people out, and all of this money is going to be contributed to that. All right, so the corporate battlefield. Why did we start the corporate battlefield? I like to start every webinar we do with this, just to make sure that people understand why I was motivated to go create this group. The name itself, the corporate battlefield, alludes to a battlefield that's out there. And those of you that know me know I'm a military guy, so I see the battlefield in everything that I do. And we can ignore that battle that's taking place between evil and good, or we can go out and try to work on the side of good and actually produce some results there. So if you go to the next slide. The way that the world runs and the way that you can actually go and do more good, I think, is to have more power and influence. So the way that we've organized our classes and our meetings are to build power and influence, and we focused on leadership and wealth building because I believe that the most influential people in the world are those that have wealth or and are in leadership roles. So my best case outcome is to help good people build wealth and become better leaders, so that we can go out into the world and produce more hope, faith, and love, and ultimately good. So that is the corporate battlefield, and it's what we're trying to do here on a monthly basis. We have a great guest speaker. I've got a couple of books here, but one of these, or his book that he wrote, and maybe Jim can tell us a little bit about it. But I want Jim to share with you his background. Extremely successful guy, a partner of ours in our business, and helping us maximize, our wealth approach, and just can't say enough good things about him. But in his firm, really. But I'm going to let him, Jim, why don't you tell us a little bit about you and the experience you have, and when you speak, what the experience you're going to be speaking from. A partner of
You bet. So first of all, thank you for having me today. I've been a CPA for 41 years, and so don't let my youthful appearance fool you. I've been around the block working with clients, representing them in front of IRS, looking for ways specifically on how to reduce their tax liability and still follow the law strictly without, getting yourself in trouble, because there are so many opportunities within the tax law to save money, particularly when it comes to building wealth, and specifically in real estate more than any other area. In fact, I don't know if I shared this with you or not before, but my wealthiest client, actually my two wealthiest clients, both made their fortunes in real estate, not from owning a manufacturing plant, not from selling a product, but real estate is how they really made their wealth. And so over the last 40 years, I've gotten quite a bit of experience working with real estate investors, real estate developers, land investors, as well as other types of small businesses, of course, professional firms. But it's really been interesting to see all the opportunities on how you can reduce your taxes through that method. Specifically, and if you think about it, for most of us, the biggest expense you have in your life is probably going to be taxes. It's going to be more than the mortgage you pay. It's going to be more than it costs to put your kids through college. Your biggest expense for most people, I'm not talking about people that are at subsistence level, right? If you're making minimum wage, okay, that's not. But if you're a professional, if you've got a business, if you want to start your own business, if you're an investor, really truly, the biggest expense you'll have in your life is going to be taxes. And the challenge is the tax law is so freaking complicated. It would fill up a football field to have every single revenue ruling, every tax court opinion. I mean, it's very hard for most people to get their heads around it. And yet, who writes these laws? They're all multimillionaires. A lot of them are billionaires, sitting in the Senate or in Congress. And they write those laws often to benefit themselves. But you have to know all the loopholes in the law in order to find those opportunities. So what my firm is about is working with our clients to have them make smart decisions about their money and do smart things on their taxes where they can legally minimize the amount they have to render to Caesar every year. And that's what we love to do, and that's what we're really good at.
Yeah. And I'll just ask this before we jump into it, but if I'm a young motivated person, and what our last best practice is going to be to create a great team that can advise you. And let's assume I'm not trying to be a CPA. I don't want your job. What resources should I be seeking out to make myself more well-rounded in this regard and how I approach just tax strategies?
Well, the main thing, if you're going to build wealth over time, you need to at least have some understanding of taxation, right? Because different activities have different tax rates applied. Now, how do you find that? Ideally, you find a local CPA, not a huge mega firm, and not a card table in Walmart's lobby type of firm, but an actual individual CPA or small firm that's used to dealing with people with your type of situation. Yeah. And working with that type of tax professional, you can learn a whole lot about, at least at a functional level. I mean, not to make you into the CPA, but as a functional level, how to organize your affairs to pay less legally in tax.
Yeah. And how much time do you think a year do your best clients, and I'm not saying the wealthiest, I'm just saying your best clients, how much time a year do you think they spend with you to discuss things like this? I mean, realistically, not.
Probably 3-4 hours a year.
Yeah.
Something
so
like that.
Not a huge investment to
No. It's actually so cost effective. I mean, I'm the most expensive guy at my firm because I'm the founder. We have CPAs that are less expensive than me, but to spend 4 hours a year with me costs $1,000, yeah. Right? And chances are I'm going to save you $20,000, $30,000 off your tax bill. Annually. I mean, it's return on investment. It's huge, and if you ever have to deal with the IRS, ideally you're not dealing with the IRS. We deal with the IRS for you. Yeah. I had an IRS conference this morning. And just beating them on the head and shoulders with the law, because a lot of the IRS revenue agents really don't understand what the law is. I had to teach this IRS agent this morning what the law actually says, and then show them, because they won't believe you, because you have to prove it to them. But $21,000 refund for my client.
Yeah, sounds like us here in Austin, the development side of the business.
Exactly.
Okay, good. Well, let's jump into the content here, because this will I think guide us on our conversation. For me, and listen, I built the slides. I asked Jim to come in and add content and fact check me and help me answer questions. But I built these 7 slides based on the journey that I'm going through in my wealth building and just kind of the things that I'm being pointed towards. And I'll say, besides Jim's book, I've read 2 books in preparation for this. So this is Win-Win Wealth Strategies, and then Tax-Free Wealth. Both of these books were fantastic. My slides will have little screen grabs from the book that I hope everybody appreciates. But it kind of guided me, and then these conversations that I'm having with folks like Jim, this is kind of what I've settled in on. So this first slide here, is I think you got to have your mindset first. And we've already started this conversation with hey, you got to have. It's better than a mentor. You got to have a coach, and a coach to me is somebody that you pay to show up and actually make you better. So we pay Jim and his firm to make us better on this side of the business. So I think you got to be first willing to do that, and then spend the 4 hours a year to gain that knowledge. But the biggest thing that was kind of beaten in my head is the government has goals just like we have goals as business owners, and they have written a tax code to further those goals. So tax people that have done well in their taxes, like our past president, were vilified for staying within the rules that the government put out there. Essentially what he did was went and did exactly what they want them to do, and he was incentivized for that. So I think the first thing in your mind is to say, okay, well, look, the government is winning from the very things that we're getting tax breaks from. And you got to be okay with that. So just use them. Stay within the law, but use them. And then my second thing on the mindset piece, and then we'll let Jim jump in and kind of discuss some of this is, I read Rich Dad Poor Dad a long time ago. And if you're looking at the slide here on the left side of the quadrant, the employee and the self-employed, that's where the poor dad hung out, and then the business owner and the investor side, that's where the rich dad hung out. And to Jim's point about the most expensive part being taxes, this quadrant to me opened my eyes to, I may not be a business owner full time, but man, I'm going to be a business owner because there's some opportunities there that I can take advantage of, and you just gotta be aware of some of this stuff because you might be missing a big opportunity. So even if you enjoy being an employee, or even if you enjoy being self-employed, be willing to look at the other side of the quadrant because there's some opportunity there.
Absolutely. Well, let me share. Your slide, as far as the mindset, is really on point. The tax code is used by the government both as a carrot and as a stick. Okay, it's got both in there. So if you do certain things, you get specialized treatment. You might get a refund on your taxes through a tax credit. You might get special benefits, like during COVID, for example. The government would give you a very large part of your employee's salary as a tax credit just for agreeing to leave them on your payroll. And they didn't even means test it. So if your business was making money through COVID, didn't matter, they still give you the money as long as you knew about what the tax rule was. So they give you a carrot, but they also give you a stick. So if you don't pay your taxes on time, the worst loan shark in the world is the IRS, because if you don't square up with them by April 15th each year, their penalty to you is 5% a month, meaning 60% annual interest rate compounded daily. I mean, I don't even know, as horrible as credit card interest rates are, I don't know of a credit card that charges 60% interest. I mean, that's unbelievable. So yes, the tax law has both carrots and sticks. And your other chart there with the business owner and the investor, it reminds me, in my book, okay, so my book is not a get-rich book. My book is a stay-rich book. So if you've been able to have any success at all financially and put together some savings and build some wealth, I show you how to hold on to it in my book. And when I wrote it, it reminds me, there's a little chapter in there I have about, maybe before your time, okay? But we had a presidential candidate a number of years ago named Ross Perot from Dallas, right? And Ross was a self-made billionaire. He owned a company. His first company was called Electronic Data Systems. He broke off from IBM, and then later he owned something called Perot Systems. But basically, he created software for the federal government, and he made so much money doing that, he became a billionaire. And he ran for president, I think back in the 1990s. So we're talking like 30 years ago. But anyway, maybe late 80s, early 90s. But the thing was, the year he ran for president, he made over $100 million, okay? And when you run for president, generally speaking, you have to publish your tax return. I know there was a big hullabaloo about our previous president about not publishing his tax return. Most politicians publish their tax return when they're running for president. And Pro did. And so the year he was running for president, the year before, he had made over $100 million from his business and from his investments. But the thing that blew my mind about it was his average tax rate was less than the person selling you a cup of coffee at a Starbucks, less than the person behind the counter, at the kolache store that you go to or donut shop. Yeah. And you look at that and you say, how in the world does the IRS allow somebody who's making $100 million to pay a marginal tax rate less than the clerk at the donut shop? Yeah. And the answer is exactly what you have in your chart. They're creating incentives for certain things and discouraging other things. And one of the things they create a lot of incentives for is investment, development, employment. Those things are social goals of the government that they draft the tax code to encourage or discourage one way or another.
Yep. Okay, so again, you're approaching this with your mindset of, I'm not a villain by taking advantage of tax opportunities. All right, next. No,
you're smart.
Yeah.
Now, if you break the law, you go to jail. Okay, you don't want to do that, right? And the IRS has almost unlimited power. It's scary. The only entity that I know of that has more power than the IRS is a federal judge. Federal judge is like a god in their court. They can do pretty much anything they want to do. But IRS is close. So an IRS agent can look in your bank account and see exactly what you're doing in your bank account without even sending you a notice, without even getting a search warrant or anything else. They can look at anything in your personal finances. They can look at your credit cards. They have access to license plate readers. One of the things, this will blow your mind, how far out they've gone. The IRS signed a contract with a software company called Palantir. And what they're doing, what the project is Palantir, the software company, scrapes all your social media posts, whether it's on Facebook or LinkedIn or whatever, and they cross-check it against what you reported on your tax return. So if you go on vacation to the Caribbean and you're bragging about the 5-star suite you got in the fanciest hotel in the Caribbean, but you're reporting $10,000 a year of income on your income tax return, I guarantee you're going to get a visit from the IRS because now the government's eyes are everywhere, and you're even helping them know where to look when you or your kid puts a Facebook post. Interesting.
Yep. Good stuff. All right. Best practice number 2, become an entrepreneur, an active investor, or a passive investor. I put this chart here, this screenshot of the book, which really made it powerful to me to understand is the average taxpayer has an income, pays taxes on that income, and then handles their expenses. And then the super taxpayer, or the people that we're talking about that are entrepreneurs, investor, active or passive investors, they receive their income, then they pay their expenses, and they pay their taxes after their expenses. And that was it was enlightening to me. I didn't become an entrepreneur because of the tax opportunity. I learned it after the fact. But I'll tell you what, if I'd have known what I know now prior to becoming an entrepreneur, I would have turned my hobby into a more purposeful part of my life much sooner. And I think it's just understanding the opportunities of being able to write off some of those expenses, as long as you're in pursuit of making a profit. They're there, and they're encouraging that because they want you to go hire people. So, what are your thoughts on that, Jim? Just an entrepreneur and your active and passive investments, and how that could pay off big time.
Oh yeah, absolutely. Well, as a business owner, you're allowed to do things a normal taxpayer is not. Yep. Okay, so if you're working a job and you're driving from house to job every day and commuting 30 miles each way, there's no tax deduction for that. There's no write-off for that. Yep. Whereas on the other hand, if you're a entrepreneur or an active investor and you have to get in your car to go check on your investments, to supervise your employees, to get training, to go buy supplies, all of a sudden the car that was not deductible magically becomes deductible. Yeah. Same thing on credit cards. Since 1985, and we're talking about a long time ago, since 1985, you have not been able to deduct interest on credit cards unless you're using them for a business purpose. So not that I encourage people to keep balances on the credit card. It's certainly better to pay them off. But the point is, a lot of things that are not deductible for a normal person are deductible for a business owner or active investor.
Yeah. Now, I did make this comment here down at the bottom. if you're going to take some advantage of some of these opportunities, I mean, you got to document. And just a personal story, and just kind of leveraging the thought that you had on our previous slide, Jim. My wife is my business partner. When we take a trip, we are very intentional to make a part of that trip spent on business. Now, it doesn't help the expense of our kids and some of the things that we do on our trip, but as long as we have a meeting and we take meeting notes and we make that a purposeful part of our business and planning to go produce a profit in the future, and we document it appropriately, and we don't spend outlandishly like you're saying, it's within the rules, right?
Right. So here's the main thing on that. There's two things about it that I want your listeners to be aware of, because it's really important.
Yeah.
One is, when you try and deduct a trip, or if you're going to deduct a trip, first rule is it has to be inside the United States.
Yep.
Now that includes Hawaii, it includes American Virgin Islands, it includes Alaska, but no foreign countries. Okay, if you go outside the United States, try and deduct a trip to go see Tuscany or something like that, it's not going to go well with the IRS. So first thing is just in the U.S. Second thing is, what you have to be able to show the IRS if you get audited, and the documentation you have to have is this. You have to be able to show the IRS the reason you went on the trip was for business, and all these other things that you're not deducting, like bringing your kids or whatever, that's just because you were going to go there anyway. And so as long as you can show those two things. So how do you show that the primary purpose of the trip was business? Well, if you're going to meet with somebody while you're on that trip, you want to have an email or a letter or something confirming your appointment with them, ideally before you go buy your airline tickets, okay? Before you rent the hotel. Because then you can show, hey, IRS, I booked this, I scheduled right now, here we are in July. I'm looking at my calendar on the wall. I've got a training I'm going to do in September. I've got another one, two more that I'm doing in October. I've already got the training tuition paid. I haven't bought the airline tickets yet. So if I go to the IRS and they say, or if the IRS comes to me and says, well, Jim, why are you going to St. Petersburg, Florida, right, in the fall when the weather's great? Well, because I'm going for this meeting, and it's a 4-day meeting, and here's the tuition, and I booked the tuition back in July, and I didn't even buy the tickets till August or September. Yep. Obviously, it's a business trip, right? But on the other hand, if I was to pack up my kids in the car and we run off to Disney, and while I'm at Disney, I go spend 5 minutes with one client I have there, it gets a lot more problematic. So no foreign travel is number one. And number two, document that the purpose of the trip was business, and the business came before all the other stuff. As long as you do that, you don't have a problem. A lot of small business owners like yourself, like myself, have a corporation. And for those of us that are married, a lot of times your spouse will be on the board of directors, or they'll be a shareholder. It's perfectly fine to have a board of directors meeting or a shareholders meeting once a year anywhere in the U.S., as long as you're not like ridiculous about what you're spending on the costs. So, don't have a $3,000 bottle of wine at the restaurant. You don't need a $3,000 bottle of wine. Have a beer, have a margarita, whatever you're going to have a glass of wine, but keep it within reason.
Right. Okay. All right. Best practice 3. Understanding depreciation. To me, just to clarify, because I'm a real estate guy, there's physical assets like real estate that you depreciate, and then there's intangible assets like software that's called amortization. But they all are, I should say they both are income producing assets that you can deduct a portion of the value every year for the lifespan that they've identified in the IRS code. And I made this point about cost segregation too, but I learned the power of depreciation on the first laundromat that we purchased as an investment. And I spend very little time in the laundry business that we own. But because we have this accelerated depreciation opportunity, and because laundry, a lot of the value of it is the equipment, it was a really great surprise to me that we were able to speed up the depreciation of all of that equipment very quickly and offset a lot of taxable income. And again, I didn't buy the laundromat for that accelerated depreciation, but man, it was a very welcome kind of opportunity when it was brought to me. And I think that it could be a part of your wealth building strategy if you were purposeful and you did understand all these parts of it. You know, for me in real estate, and kind of to touch on the cost segregation piece, the only thing you can't depreciate in real estate is the land, unless you do land improvements. But the land is the only thing that you can't depreciate. You can depreciate residential, commercial properties as long as they're investment, and then you can segregate, have a study done on your real estate, which will break it up and allow you parts of the improvements that you can depreciate on a faster timeline. So I think two things. One, just understand that depreciation and the savings that you get on that, it should be a part of your strategy. And then even on your exit, right? If you're buying with depreciation a big part of the value while you're buying something, personal property, you're done depreciating that after 5 years. That might be the first time that you look at selling the asset, because if you've already depreciated it fully, then you might be able to trade that into a new asset and recover some of that opportunity on the depreciation. So how have you seen, Jim, depreciation used in kind of the wealth building and wealth preservation strategy?
Yeah, it's actually a very significant aspect of it. And certainly since the middle of the Trump administration and continuing into the Biden administration, there have been special provisions added to the tax law to allow the acceleration and expensing of things that in the past you used to have to write off over a period of years. So cost segregation is a perfect example. When you have a commercial piece of real estate, traditionally you've had to write it off over 31 and a half years. Yep. So if you bought a $300,000 property, you'd only get a $10,000 deduction each year for 30 years. And it's all about the time value money, right? So yep. Time value money says, if I can have the deduction today and I get my taxes cut today, time value money has more value if it spends its time with you rather than with the IRS. Right. So take the deduction today and get the tax refund today. Now, the cost segregation is taking some of those component costs that are part of that real estate, whether it's an air conditioning system or maybe appliances, if it's a apartment building, whatever it may be, and you can all of a sudden just expense them in a single year. And most of the accelerated depreciations from cost segregation will continue at least through 2025. Now, in 2025, a lot of the accelerated depreciation will claw back to lower levels because they didn't make the tax cuts they put in effect under Trump permanent for small business owners. They made them permanent for C corporation owners like the Microsofts and the Walmarts and the AT&Ts, but for small business owners like ourselves, they made them temporary to expire in 2025. So, but that doesn't mean they won't renew them, and that doesn't mean that they're gone for good, because every few years they change these rules. But the bottom line is, if you can expense an asset sooner, you get a reduction in your taxes that can be very significant. And even if you depreciate it down to zero and then you go to sell the asset, well, historically, if you go to sell assets that are depreciated, you have to pay a capital gain on the full value, including what was depreciated. You might even have to do something called recapture depreciation. But the point is, if it's real estate, you have another option under the tax code, which is a 1031 exchange, meaning that you can trade that property for another property of like kind. And like kind is very loosely defined. I don't want to get too granular, but the point is, even after taking those big depreciation write-offs, you can still sell the property without necessarily paying tax today if you do a tax-deferred exchange. So a lot of opportunities to save money using depreciation.
Yeah, and I think real estate, I think equipment. I think you just got to become a student of it and at least be educated enough that a part of the value in the asset that you might be acquiring might be that write-off. If you're really close on a negotiation and you haven't factored that in, you might walk away from a deal that like the laundry deal. You might walk away from it for an immaterial amount of money based on the savings that you actually might get from that opportunity there.
We had the same thing with a client of ours that built a car wash, right?
Yeah.
Yes, they had land. Yes, they had building, but they had like almost $1 million of equipment.
Yeah.
And that meant, for two owners, they could each have a couple $100,000 a year of income from a regular job and pay no tax on it because of the expensing depreciation on the equipment for their car wash.
Yeah. Now,
very powerful.
One thing, Jim, those of us that enter into partnerships with folks, to get that, you have to be signing for the debt, right? Like you have to be a guarantor of that debt, or am I understanding that correctly?
Typically, yeah.
Yeah, okay. All right. Well, let's go to best practice 4. All right. My favorite, and we already talked about a couple of reasons, but real estate. I took this quote directly from one of the books that I read. The single best tax shelter in most countries is investing in real estate. We've talked about depreciation. Jim just hit on the 1031 tax exchange, being able to delay many times indefinitely gains, the taxes on those gains in real estate. But even your personal residence, I just finished up reading the book, Jim, Getting Rich Your Own Way. And they don't publish it anymore, so if you go to try to buy it on Amazon, the cheapest one's $200. But they did a study on a group of people at very different levels of wealth, and the most wealthy people on average said their best investment they ever made was in their own house. And they just accidentally did that. But I think a lot of us can identify with that. You look at what assets you have that really produce most of your wealth, and you look at your home. And as it's written today, if you're a married couple, the first $500,000 in gain there is written right off. And you can move on, and you even have some ways to write off additional amounts. And then I learned this a couple of years ago about the Augusta rule, but being able to use your primary residence as a short-term rental 14 days out of the year and not have to pay income taxes on that. I mean, that alone is a great opportunity when you live close to downtown in Austin, Texas. So just a ton of opportunity from the tax perspective in real estate and what you can do with it.
Oh, for sure. I mean, Austin, Texas, you have South by Southwest every year. You could probably rent a house for a couple $1,000 a night.
Yep.
And you do it for 14 days, there's no tax. The Section 1031, yes, you can defer the tax indefinitely, but sometimes you get to defer it permanently. Like I was sharing with you, I had one of my clients pass away at age 99 who was a very active real estate investor. Yeah. He had properties that he exchanged back in the 1950s that he hadn't paid tax on in 60, 70 years. Yeah. And then when he passes away, it's still not taxable. You get what's called a step up in basis, where the tax basis of the property, even if it was zero, goes back to the full current market value, and you get to depreciate it all over again, as if you had just bought it brand new. It's really interesting.
Yeah, just so many advantages, and I think again, you need, because it's such a big opportunity. I think you got to find a mentor that has done this, at least for a handful of years, and has some thoughts about it, some ideas, some things to correct your assumptions. But yeah, it should be a part of your wealth building and wealth preservation kind of strategy there.
Well, the other thing about it, personal residence, time goes by and you don't even realize sometimes how fast the property value is going up. I think in my own house, I've got a 1960 ranch-style house in Houston, Texas, in an amazing neighborhood. I mean, I really am in a fabulous location, so that is important. But I've been in the house for almost 25 years now, and I haven't thought about the value every year. But I tell you what, I've kept on up recently with what's going on in the neighborhood. That house I paid $297,000 for is now worth $1.3 million. Yeah. Okay, I made $1 million just sitting in the house, and I haven't just sat in the house the last 25 years and done a lot of things, but I mean, my God, I didn't do anything special. I bought in a great neighborhood, okay, but there's a lot of great neighborhoods out there, and wow, it makes you wish you had a time machine, you'd go buy 5 of them or something.
Yep, I believe in that. Okay, best practice number 5. understand the use of qualified plans. The qualified plans, just for the terminology standpoint, is those plans that are controlled by the government, and then they incentivize you in different ways for different types of plans to use those. And I have an advisor, financial advisor. I have obviously who have tax strategists. I contribute to the qualified plans. I wouldn't say that it's a core focus of mine with wealth building, but I think you should understand what opportunities you have with those qualified plans, and then I think you should always understand how do those qualified plans match up against your non-qualified opportunities, because I think a lot of people just taking the easy way out. They just hit that qualified plan every year, and it's what they do, and they don't ever ask a question about it. But you got these non-qualified opportunities like real estate, where sure, not all of the tax opportunities are, one for one, but just in your story that you just told, sometimes we can write those things off indefinitely. I think you just gotta hold your money accountable in your strategy, and just understand, all right, how much is appropriate to put toward the qualified plan, and how much is appropriate to pursue these non-qualified plans to build and protect my wealth.
Right. So the qualified plan, just so everybody's on the same page, most of us call any type of retirement plan. What we would call a retirement plan is a qualified plan. Yeah. So it's a pension plan, it's a 401k, it's an IRA, it's a Roth account. Any type of retirement plan is what's called a qualified plan. And a couple of things about it that's specifically more important here in Texas is Texas and Florida are the only two states in the entire country. So 48 states don't do it like us, but Florida copies us. Actually, we started doing it first because ours go back to Reconstruction after the Civil War. So we came up with these rules called the Homestead Rules. Well, under the Homestead Rules, anybody who lives in Texas, is a citizen of Texas, can have an unlimited amount of money in their qualified plans, and they are absolutely exempt from any creditor or lawsuit with unlimited amounts. Okay, nowhere allows that other than Texas and Florida. We've been doing it longer, but very powerful. The other thing about qualified plans is people don't really understand the power of compounding. My story that I mentioned a few minutes ago about my house I bought 25 years ago, quadrupling in value. Well, that's great, but it's all because of the time I was in the house, because some years it probably went down, some years it probably went up. But after long periods of time, the compounding just gets really powerful. Same thing in qualified plans. So, you can put, for example, a Roth IRA. If you have a kid that's in high school and they get a job working at Chick-fil-A or Burger King or wherever they get a job working, as long as they have earned income, they can have a Roth IRA even before they're age 18. And a Roth IRA is the only qualified plan in the United States that's tax-free for life, 2 generations. So if I leave my Roth IRA to my 2 kids, David and Alexis, they'll never pay tax on it either, even after I went my whole lifetime without paying tax on it. So use of qualified plans properly is super powerful in wealth building.
Yep. And so just, you're coaching your kids here. How much time do you guys spend on deciding, well, how much should we put on the qualified side versus how much time should we spend investing maybe in other types of non-qualified type investments?
Well, what I see typically for myself, for my clients, is the qualified plans have such restrictions on them that it's probably not going to be the majority of your savings if you're a saver. Okay. So, for example, for a kid who's in high school, the maximum they can put into a IRA or 401k is the amount of earned income they have. So if they're in high school in the course of the summer, they make $3,000 or $4,000, that's a limit on how much they can put in. Even if they are done with college, they get their first job. Like my daughter's working in Austin for a software company. She's doing great. She's got a great job. They allow her to contribute her salary to a 401k plan. Well, the IRS says if you're under age 50, the most you can put in a 401k is $23,000. If you're over age 50, you can go up to $30,000. and that's not counting any matching which comes on top. So, if you're living below your means, which is the goal if you want to have a future, is spend less than you're making. You might be, after your cost of living, you might have $50,000-$60,000 to work with. You can only put a max of 23 in the qualified plan. So usually the qualified plan is not the majority of your money that you save anyway. But to the extent that you have to decide how to allocate, typically we like to see 50-50 until you get to the point where 50% is more than what you're allowed to put in, and then you just go heavier. End up 60-70%.
I think that's an easy model to remember, the 50-50. Okay, let's hit strategy number 6. All right. I didn't start, again, I'm a military guy. I fought in both wars, Iraq and Afghanistan. I believe truly that I was bulletproof until I hired people to help me out. And they said, you're not bulletproof. You need to start thinking about how you transfer your wealth and start doing it now so that it happens really well when it matters. So I put this best practice 6 here is, know what a will and trust does, and how you're going to use it, and then start paying attention to what your estate tax would be, so that if you could make decisions now to affect that, then you could start doing it. And I grabbed the screen grab of the book here for the will and trust, and really for me, the value in the trust is avoiding the probate, which is an expensive endeavor, not to mention painful, but just expensive. But then also, just being able to direct what based on the dynamics of your family or whoever you're going to leave your wealth to, and leave no doubt, so that it's simple. That's why I thought you would use those. And then there's the point of a trust being a very good entity to protect your assets, kind of like you were saying. If you were to be sued or something like that, the trust could protect your assets as long as the beneficiary is different than the grantor. And then just this estate tax mentality. The more you have, the more tax you're going to pay. So the more you have, meaning the more value you have in your estate. And there are unique ways of transferring the value of your estate to those that you're going to give that to, by just paying attention to how you do it. So at least the book answer was maybe looking at a limited partnership and how you can allocate shares over time. That way you don't just give a full asset all at once and pay tax on that. You can create a partnership and assign shares of that partnership over time to stay within the gift tax kind of bucket there. But also, this whole idea of discounting the value based on how you award it, and the two terms that they have with minority and marketability discounts. Basically, your shares are worth less when you don't have any power, and when it's just partial ownership. You can actually discount the shares, so the value of that asset, even though market value is different, but the value as it's recognized is lower. So conceivably, you give more away faster without the tax. So just these concepts of having awareness of those, so that when you're communicating with your team, you actually have an idea and you can be real intentional about it.
I totally agree with you on that one. Now, there are different types of trust. You can have a living trust, which works basically as a substitute as a will for your will. And there's a lot of advantages to having a living trust. A couple of them, for example, when you have a trust, you can put a lot more restrictions on your beneficiaries than if you just have a traditional will. Yeah. In most states, including the great state of Texas, a child becomes an adult fully for legal purposes the day they turn 18. I can tell you that most 18-year-olds are not mature enough to handle large finances. So I had a client die about 6-7 years ago. He was a medical doctor in San Antonio. He, at the time he died, had a net worth of about $20 million. He was a single dad at that time, and 2 children, both at University of Texas in Austin. And, both kids were over 18. So if he had not had a trust, if he just had a normal will, each of those kids would have gotten a $10 million lump sum on one day, right? And I'm sorry, but an 18-year-old doesn't think like a 28-year-old, doesn't think like a 38-year-old, and they're just not ready to have $10 million dropped in their lap, because you'll see the party signs and the bonfire all the way from across the state.
Yep.
They'll be having such a grand time, but they'll blow through the money.
Yep.
So with the living trust, you put a lot more restrictions. So even for my own kids, and I love my kids dearly, but I've told them, look, when dad moves on to the next place God has in mind for him, you're not going to get a lump sum. You're going to get an income from my trust, because I don't want you to have the stress of having a large sum to distribute at one time. And the other thing, by keeping it in the trust, you maintain separate property status. So if you have a daughter or a son who goes out and marries a knucklehead, God forbid, right? All your hard-earned money that you spent a whole lifetime to put together is not going to disappear with their ex-spouse. Because if you have it in a trust, it stays separate property forever. So a lot of advantages to having the trust: asset protection, income tax planning, family planning, control. A lot of good things can happen by having a properly drafted trust.
Yeah, that's a great point. It just dawned on me. I'm a very positive person, so I think very rarely of like what could go wrong. So again, just you bringing that point up about community property. I personally haven't thought of that. I have a trust. I have thought that, like, yes, 18-year-olds don't deserve all the money at once. So I had thought about multiple payouts and that kind of model there. But I didn't think about just the point you made there about the community property and essentially ensuring that they don't have to make that decision. I can make it for them. There's no hard feelings, and they're protected.
Right.
They're protected.
I mean, if you leave, let's say you leave, just to make up a number, right? If you leave a kid $3 million, okay, the income from interest and dividends that they can pull off that $3 million is around $150,000 a year in a diversified portfolio. They can pull about $150,000 a year without touching the principal, right? I'm sorry, but in today's dollars, in adjusting for inflation going forward, 150 is enough. If that kid needs more than 150,000, they can get a job. It's okay. Go work, right? Exactly. But they'll never be homeless. They'll never be shoeless. They'll never be without medical care, food in their tummies, and all that. They'll be, have clothing on their back. They may not be able to buy a Lamborghini, but that's not our goal as parents necessarily, to get to work really hard and sacrifice so our kids can drive Lamborghinis while we're driving, a 20-year-old pickup truck. No.
Yeah.
That wasn't the goal. But you can take care of the next generation. And you can also protect them, not only from themselves, but also from people who may wish to take advantage of them. Yeah. And that's really, if you're going to be a good steward and you love your family, you don't want to have somebody else come in and hurt them.
Yeah, great point. Okay, best practice 7, build a great team. To some extent, I'm going to let you sell yourself here, because you play an important role in people like myself,
right.
Our lives. So I think that you communicating your value would be the best way to do it. But I read this quote in the book, and I thought it was fabulous. We as the taxpayer, or as your client, we have all the answers. What we don't have is all the right questions. And that's, to me, that was gold when I read that, because I'm a smart guy. I've got an idea, right, about all this stuff, but I don't know all these questions that if I have the answers, but I don't know all the questions to ask to get me where I need to be to take the max value out of it all. So
right.
as you're building the team, can you talk about, one, just as a tax advisor, what you're looking for, and then just teaming up with a financial advisor, how those roles play together there?
Sure. So as a tax advisor, so the main thing is, if you're looking to build a team that's going to help you create or hold on to wealth, and they both have their own unique challenges, for sure you need a good lawyer, you need a good CPA, and you need a good financial advisor. Those things you absolutely need to have. Ideally, you also have some mentors, maybe some people that can hold you accountable on your goals. Maybe a coach, for example, would be perfect for that. But on the tax advisor specifically, there's basically two types of CPAs out in this world, okay? The traditional and most common type of CPA you will find is one who will take whatever you've done and account for it, put it on the tax return correctly, but they're looking at the past. Whatever you've done in the past, that's what's on the tax return. So essentially, they're driving, looking only out the rearview mirror because they're only looking at the past. And if you want to save on taxes, what you need to have is someone who's forward thinking, who's looking at your situation and saying, okay, where do you want to be 3 years from now, 5 years from now, 10 years from now? Okay. And yes, I hear what you said, that you're a positive person and you don't like to think about bad things that happen. But, your tax advisor also needs, and your financial advisor hopefully too, needs to be a designated worrier where they look at what's the best thing that can happen on one end. If this happens, everything's great. They also need to look at what's the worst thing that can happen. If everything just falls apart and disaster strikes, your health is gone, you get sued by a tenant, all kinds of things can happen in business. I used to own a lot of apartment buildings down in Galveston. One night, 2 o'clock in the morning, I was dead asleep. I get a phone call, ring, ring, ring. It's the property manager. Jim, the building's on fire. What should I do? Okay. You want to wake up fast at 2 o'clock in the morning. You don't need espresso. Get a phone call like that. It'll wake you up. Yeah. And so you have to plan for all the bad things that can happen. You got to plan for all the good things that can happen. Reality will be somewhere in between. And the main thing for selecting a tax advisor is get one who will do tax planning for you, not just filling out the forms. That's the most critical thing, because that's where they add value. A lot of people can fill out the forms correctly. Not everybody can ask the right questions to figure out what your real true goals are, and then put it together with the tax law in such a way where they dovetail together and you pay less tax. Yeah. That's the critical part.
Yeah, yeah. And I just say selfishly, in those 4 hours a year, kind of teach you, because
right.
You're not going to spend a lot of time learning this part of the business, but I think having someone that's willing to not only ask you a question, help you do the right thing, but also understand, well, why? Why is this the right thing? I think that's a big part of it.
You need to have a functional baseline. Absolutely.
Yeah. I'm a math guy. I mean, if I just understand why, I can do the math. It's just sometimes I don't know where it all plugs in, but when I got it, then I can do it. Yeah. Yep.
Right.
Awesome. All right. Well, look, I think we should give everybody a chance to ask some questions. So we'll give you a minute or two to type in your questions. While you do that, again, I'm going to mention this wealth conference that we're hosting in October. It's on the 12th and 13th. Got some really great speakers coming to that. And I didn't make you pay to join Jim and I on this conversation. But what I will say is, like going to church. If you got value from this talk that we've had here, I don't care if it's $5, I don't care if it's 10, I don't care if it's 100, but please visit us on Venmo and just text us that dollar amount at Corporate Battlefield, and we will give all of that money to teachers in financial need. And we've given tens of thousands of dollars away, and we just really, if you could be along the ride with me, you would give that $5. But just as a testament, it's a beautiful thing. The timing's always great because we ask people who needs it. And those of us like myself that have kids that are still going to school, these teachers, they are the future of our world. They're training the future of our world, and they don't get paid near the amount of money for the job that they have to perform. So, we can play our little part there to give money. That'd be great. All right, Jim. Well, it looks like we don't have any questions here. You all have my contact information. Please do reach out. Jim, I just want to say thank you so much for sharing your wisdom with us. And I'm just grateful to have you on our team.
My pleasure.
All right. Thanks, Jim.